When we talk about the future investor mindset, we are not talking about secret tricks, overnight success, or becoming rich without effort, because that story does not match real life for most people, especially in today's economy where prices are rising, jobs are changing, and certainty is rare. A future investor mindset starts with understanding how money actually works in the real world and how it flows through your life. Most people are taught to think about money only as something to earn and spend, but an investor mindset looks at money as a tool that moves, grows, protects, and supports long-term stability. This mindset begins with accepting reality instead of fighting it. Inflation slowly reduces the value of cash sitting idle, traditional job security is weaker than it used to be, and the cost of housing, healthcare, and education keeps rising faster than wages for many workers. A future-focused investor does not panic about these facts, but also does not ignore them. They calmly adjust their behavior to match the environment. That means understanding that saving alone is not enough, but reckless investing is also dangerous. The balance between caution and growth is where the modern investor lives. One of the first mental shifts is moving away from the idea that investing is only for rich people or financial experts. In reality, investing is simply the act of putting money into systems that can produce more money or protect purchasing power over time. This can be as basic as contributing to a retirement account, buying broad market index funds, or slowly building ownership in productive assets. The future investor mindset respects time as the most powerful factor. Compounding does not require genius, it requires patience and consistency. Many people underestimate how small, regular contributions over many years can grow, and overestimate how fast large gains can happen in the short term. The future investor understands that boredom is often a sign that a strategy is working, because steady progress rarely feels exciting. Another core idea is income systems. Relying on a single paycheck is increasingly risky, not because jobs are bad, but because concentration risk is real. When all income comes from one source, any disruption can cause stress and force bad financial decisions. A future investor mindset looks for ways to diversify income over time, not necessarily all at once. This could mean developing a skill that can be monetized online, building a small side business earning dividends, or creating digital products that scale slowly. The key is not chasing every opportunity, but building systems that fit your skills, time, and energy. Many people fail because they copy strategies that worked for someone else in a different situation. The future investor studies options, then chooses what aligns with their real life, not their fantasy life. Saving also changes meaning under this mindset. Saving is not about hoarding money or depriving yourself forever. It is about creating flexibility. Cash gives you options, reduces stress, and allows you to invest when opportunities appear. An emergency fund is not a boring rule, it is a form of self-respect. It prevents high-interest debt, protects your investments from being sold at bad times, and gives you mental clarity. The future investor saves with purpose, not fear. They know how much cash they need for short-term stability and how much can be put to work for long-term growth. They also understand that investing basics matter more than complex strategies. Understanding what stocks represent, how bonds work, why diversification matters, and how fees quietly eat returns is more important than predicting the next hot asset. A stock is ownership in a business, not a lottery ticket. When you buy shares, you are buying future cash flows, and those depend on real products, real customers, and real management decisions. The future investor mindset respects this connection and avoids treating markets like a casino. Risk awareness is another pillar. Risk is not just market volatility or price drops. Risk includes inflation risk, career risk, health risk, and behavioral risk. Holding too much cash can be risky in an inflationary environment. Taking on too much debt can limit future choices. Chasing trends can lead to emotional decisions and losses. The future investor does not try to eliminate risk, because that is impossible, but tries to understand and manage it. This includes spreading investments across assets, industries, and time, and also investing in personal skills that increase earning power. One of the most overlooked investments is self-investment, not in motivational content, but in practical skills that the market values. Learning data skills, communication, problem-solving, or technical tools can increase income more reliably than many financial products. The digital economy has expanded opportunities, but it has also increased competition. A future investor mindset recognizes that online income is not passive by default. It often requires upfront work, ongoing maintenance, and adaptation. The difference is scalability. Digital systems can reach more people without proportional increases in cost, but they still demand quality and consistency. The future investor avoids the trap of thinking passive income means effortless income. They understand effort can be front-loaded instead of constant. Debt is another area where mindset matters deeply. Not all debt is evil, but not all debt is helpful. High-interest consumer debt is often a barrier to investing because it drains cash flow and increases stress. A future investor prioritizes eliminating toxic debt because the guaranteed return of paying off high interest is often better than uncertain market gains. At the same time, they understand that some forms of debt, like reasonable mortgages or business loans, can be tools if managed carefully. The key difference is whether debt increases future earning capacity or simply funds consumption. Cash flow awareness ties all of this together. Many people focus only on net worth numbers, but cash flow determines daily life. You cannot pay bills with unrealized gains. A future investor tracks where money comes from and where it goes, not obsessively, but intentionally. This awareness allows small adjustments that compound over time, like reducing unnecessary expenses and redirecting that money into investments. It also helps avoid lifestyle inflation, where increased income leads to increased spending without increased security. The future investor is not anti-enjoyment, but pro-balance. They spend on what truly adds value to their life and cut what does not. Inflation is often misunderstood, but it is central to the future investor mindset. Inflation is not just rising prices, it is the gradual erosion of purchasing power. Over decades, it can quietly destroy the value of savings if money is not invested. The future investor plans with inflation in mind, understanding that a dollar today will not buy the same in the future. This affects retirement planning, wage negotiations, and investment choices. It also explains why long-term growth assets are necessary, even if they feel risky in the short term. The mindset also includes emotional discipline. Markets move, news changes, and fear spreads quickly. The future investor learns to separate noise from signal. They understand that headlines are designed to capture attention, not guide personal finance decisions. They develop rules for investing and saving, then follow them through cycles. This does not mean ignoring new information, but it means avoiding impulsive reactions. Emotional control is a skill that improves with experience and reflection. Another important shift is redefining what success looks like. The future investor does not measure success by flashy purchases or comparison with others. They measure it by stability, freedom of choice, and progress toward personal goals. This might mean having the ability to change jobs, take time off, support family, or retire with dignity. These outcomes rarely go viral, but they matter deeply. The future investor mindset is forward-looking, but grounded in present action. It does not wait for perfect conditions, because perfect conditions never arrive. It starts where you are, with what you have, and improves gradually. It also accepts that mistakes will happen. Losses, bad decisions, and missed opportunities are part of the process. The difference is learning and adjusting rather than quitting or doubling down emotionally. Modern work opportunities also shape this mindset. Remote work, freelancing, and platform-based income have created flexibility, but also uncertainty. Benefits are often self-managed, and income can fluctuate. The future investor plans for this by building buffers, diversifying income, and understanding taxes. They treat irregular income with discipline, setting aside money for future expenses and investments before lifestyle spending. They also recognize that the future of work will likely require continuous learning. Skills can become outdated, and adaptability becomes a form of financial security. Investing is no longer just about markets, but about positioning yourself within a changing economy. The future investor mindset also values simplicity. Complexity often hides costs and risks. Simple, transparent investment strategies are easier to stick with and understand. This does not mean ignoring innovation, but approaching it carefully. New financial products and technologies can be useful, but they should be evaluated based on fundamentals, incentives, and risks. The future investor asks basic questions before committing money. How does this generate returns? What could go wrong? And how does it fit into my overall plan? They avoid investing money they cannot afford to leave untouched for long periods. They respect liquidity needs and time horizons. Retirement planning is another area where mindset matters more than specific numbers. The future investor understands that retirement is not an age, but a financial condition. It is the point where income from investments and systems can support living expenses. This requires realistic assumptions about returns, inflation, healthcare, and lifestyle. It also requires starting earlier than feels necessary, because time reduces pressure. Waiting for higher income before investing often delays progress. Starting small builds habits and confidence. The future investor also understands taxes as part of investing, not an afterthought. Tax-advantaged accounts, long-term capital gains, and efficient asset placement can significantly affect outcomes over decades. This does not require advanced strategies, but basic awareness and planning. The mindset includes a healthy skepticism toward financial advice, especially advice tied to selling products. The future investor seeks multiple perspectives, understands incentives, and avoids blindly following anyone. They know that no one cares more about their money than they do. At the same time, they respect expertise and are willing to pay for quality advice when needed. Community and discussion also matter. Learning from others, sharing experiences, and staying informed helps avoid isolation and mistakes. However, comparison is dangerous. Everyone's timeline, income, and responsibilities are different. The future investor focuses on personal progress rather than external benchmarks. They understand that slow growth is still growth. Over time, the future investor mindset becomes less about money itself and more about alignment. Money becomes a support system for life goals rather than the goal itself. This mindset reduces anxiety because decisions are guided by principles instead of emotion. It creates resilience because plans include uncertainty. It creates opportunity because preparation meets chance. The future investor does not wait for permission to think this way. They build this mindset step by step, learning, adjusting, and staying grounded in reality. In a world of constant change, this mindset is not about predicting the future, but being ready for it.